Hello, everyone. Welcome back to another episode of Signal or Noise, episode 49. I'm Charlie Bilello, and with me, as always, Peter Mallouk. Peter, two topics today. We're going to discuss what matters for the stock market in the short run and then the long run. And then we're going to discuss the big decline in the U.S. dollar index over the past few months and try to decipher whether that's a signal for the markets or simply noise. Okay, let's start out. What matters in the long run? This is really an extension of a post you put out on X, and I'm just going to read it here. What matters in the short run? Tariffs, interest rates, sentiment, a million other things. What matters in the long run? You just have one thing there: earnings. Speculators focus on the short run. Investors play the long game. Good advice there, Peter, but I want to dig into that short run because, of course, that gets all of the attention today and a lot going on in the short run. Obviously, every single day, the situation seems to change with tariffs. The latest as of today, and this could change by the end of the day, and by the time we post this video, it could change. But here's the latest kind of a summary of where we are today. 25% effective tariff rate overall. Obviously, China over 100%. And if you assume there's going to be a shift, so post substitution, it's down to around 15%. Both of those numbers, obviously, the highest we've seen in a long time, either 1930s, so you're talking about close to Great Depression levels, or if you're not incorporating substitution, you're going back even further. Peter, what's your latest take on this tariff chaos? It really is chaos. Every single day, information changes. The last time we spoke, we were right in the midst of the craziness, and the equity markets, we were saying at the time, don't seem to believe that these rates are going to be anywhere near these levels when the trade deals are ultimately reached.
Yeah, I mean, when we first discussed this, one of the things that I said was I really thought we were going to get a conclusion that was going to come much quicker, I think, than the administration was indicating and that most pundits were saying, that it might go a couple quarters at most. I think we've already seen a lot of very dramatic changes in signaling. We've already exempted iPhones and some things to do with auto, and indicated a pause with some countries, and starting to negotiate with almost every country. And now the administration is saying they expect a quicker resolution with China. This is a huge pivot from where we are. The market no longer believes that this is going to be an ongoing war. If it did believe that, it would be down probably 30% even from these levels. If it really believed we were going to be a multi-year tariff war and we we're going to repatriate all these jobs back into the United States. I
So I
think with
guess
the
then,
market,
yeah, the question is the market right or is the market wrong in
right,
making that assumption?
right. I think the reason the market's not back at its all-time highs is it doesn't really trust the path to get there, right? So no one knows. There is a lot of uncertainty around how will policies change, the speed with which they will change, will administration change their mind? I mean, there's just not a lot of predictability here. The market definitely does not believe there's a real solid long-term plan here. And I think that's why you see the uncertainty in the market. It's not comfortable what's behind us to go to an all-time high. It's not doesn't believe this is going to go on forever. It believes there's a path out of this, but that mistakes could continue to be made as we work our way there. And that's why we see these 2% swings every day based on what one person might say at any given moment within the administration. And so the answer is the market has no idea, and neither do I, and neither does anybody, about the ins and outs and the twists and turns we're going to take here in the coming weeks. I'm optimistic. The market seems fairly optimistic at the levels that it's at, and I think it's probably priced right.
Do you think then if we get a deal, let's say in the next few weeks, that would lift that cloud altogether? Or do you think depending on what that deal looks like, well, then now we have to worry, is this going to cause a recession? Is it going to cause short-term inflation or other factors?
I think it matters a lot what the deal looks like. I mean, if we get done with the deal and say, oh, TikTok is going to be sold by China and China's out of the Panama Canal and we're changing tariffs 2%, market's going to soar. If it's going to be, hey, we're going to exempt these things, but keep these things, and these jobs are and all that kind of thing, then it's going to be a long road back to all-time highs around this particular issue. It's not just China we're talking about either. So I think we need to see some sweeping resolution to all of this in the coming months before some permanent damage happens.
Yeah, and I'll say it again. I think the biggest difficulty, depending on how you look at it, and even if you look at it in the most charitable way and say this needs to be done because we can't be dependent on China, we can't be dependent on other countries, we need to bring manufacturing back. Even if you have that belief and you think that's ultimately a good thing long term, you can't just flip a switch and do that tomorrow without causing severe economic harm. I think that's the part that's kind of missing. And I think that's why everyone's assuming you're going to see a reasonable deal reached because the economic pain in the short term, Peter, is just too great. And just judging by the way they reacted that very first day when the tariffs were implemented, they didn't even wait to the end of the day before reversing course because the stock market and the bond markets were reacting so violently.
Yeah, I mean, the bond market, I think, is what really spooked them. Very unexpected move there. And I think it shows that there is not enough conviction to withstand a real economic sustained impact. That was, I think, the first clue that this is not going to be a long game, but we'll see.
Yeah. So the idea that this is going to be a drawn out thing where we're going to take short term pain for long term gain in American politics, that simply doesn't work because very quickly we're going to be talking about the midterm elections coming up. And even if President Trump and his inner circle are in favor of this stuff, while all of the other people surrounding him are going to want to be reelected, they're not going to continue to support it. Then you have all of the business interests, obviously, already in his ear saying this is going to cause major problems. And obviously, Elon Musk, interestingly, is in that camp as well, right, Peter? So one of the few things they have a big disagreement on is tariffs, and he's been pretty quiet about criticizing the president, but not quiet about criticizing other people in terms of the tariff policy. Obviously, Musk coming out very much against high levels of tariffs.
Yeah, it was interesting to see the kind of transparent infighting around that issue, and even among the advisors that are advising on tariffs. To your point about China and the U.S. short term pain, not only the U.S. is the American consumer is unable to sustain short term pain. Like something that goes on in the United States for 6 to 12 months is a very, very, very long time, and would put the midterm elections in jeopardy and paralyze the administration. I think that they're going to do everything they can to prevent that from happening. China, 5 years is nothing. Like, I mean, they will take pain for 5 years. They think generationally there's no
Mm.
elections coming up and so on. And I think that's probably the big miscalculation here is this idea that we're going to, rattle China and they're going to come like on their knees to the table in 5 days. I think this is going to be really interesting to see what the outcome is here. I do think the administration is going to get concessions. They're not going to be serious big ones, but I do think they'll get some, and hopefully we can just get this resolved quickly. I think we're seeing clues. I mean, including the comments coming out of the administration yesterday, the day before yesterday, about them expecting a breakthrough with China, as if discussions are already happening.
Yeah, it seems to be a shift in terms of who's taking control here. Secretary Bessent has been more vocal. Obviously, he's a markets guy, a hedge fund investor in his prior life, and he seems to be increasingly coming out with the narrative of calming the markets down, saying you're going to see a deal that the prospect of de-escalation is coming, and no one. And I think that Peter's this is an important point. No one thinks the current status quo is sustainable. So that's an admission of saying these 145% rates, they're not sustainable. And as you're saying here, this game of economic chicken with China, you're probably not going to win that game because they will outlast you in terms of they can do this for a longer term. They could quiet their citizens. We don't have the ability to do that. Americans are going to get very mad very quickly if this turns into an economic downturn.
100%. And I think that's, I mean, I think the change in language in the last few days, I think is promising.
Yeah, and so on that point, just the news of a potential deal, Peter's obviously boosting markets here. And we're going to see, we talked about the continued volatility and it cuts both ways. And that's a reason why investors shouldn't try to time this stuff because the up moves can be violent as well. We're seeing that today, the Dow up over 1,000 points, S&P 500 up over 3%. You're going to see continued headline driven moves like we haven't seen in a long time because it really is the case that one headline can change things if a big deal is reached. So it's an unusual situation where everyone's waiting for the outcome that everyone thinks is going to happen, and yet it still has the ability to move markets when it comes.
Yeah, I mean, it's the market is really trying to. We talk about the long term being about earnings, and it's taking all these pieces of information and repricing in real time future expected earnings, and that's why we see these swings. In a world where tariffs get resolved, future earnings are going to be much higher. In a world where there's an ongoing trade war, future earnings will be much lower. And so every incremental decision and comment that happens in between, it has a very big impact on potential future earnings, and the markets just absorbing this in real time is kind of exciting to watch if you understand markets, and can be really scary if you don't.
Right. Okay. Let's go to number two, interest rates here, Peter. And a lot's been made on the 10-year Treasury yield. And obviously, looking at this spike over here, very unusual during a market sell off. And that's, as we talked about, probably the primary reason why they did a 180-degree reversal on that very first day that the tariffs were set to be imposed. And what we've seen since then, Treasury yields have come in. They're actually lower on the year. They're boosting returns for bonds, which have acted very well this year overall. If we're looking at as a hedge against stock market declines, done their job. But the big question for interest rates, always, Peter, is what will it mean for the stock market in terms of it does the direction of the 10-year Treasury yield, and a lot of people think it does. Do we need it to go lower? Do we need it to go higher? Do you have a view on that in terms of interest rates? Because there's so much attention being focused on it today.
I mean, it is very hard in the short run to really use this as a tool for expected returns over the short run. And the reason is, if rates are lower, the cost of capital for businesses is lower. If you think about a consumer, your mortgage is lower for your home. The payment you're going to pay on a new car is lower. On a washer and dryer and a refrigerator that you're financing is going to be lower. So it seems like, hey, that's good. That means the household's more profitable. Or if you're a company and all the costs of financing are lower, then you're going to have more earnings. But if rates are declining, it's usually because the Fed sees weakness, right? It sees weakness in the economy, so it wants to lower rates to stimulate the economy. So you really can't look at it and go, well, it's a little lower, therefore it's good, or therefore it's bad. It's a mixed bag. There's no question that if we have sustained lower rates, that's obviously good for business and good for the consumer. But you really only have that for the period of time where the Fed perceives there to be weakness. So it's a catch 22, and it's too much to read. It's too much to read into this one thing. Trump really wants lower rates, and he's pushing Powell very, very hard. I think actually to his detriment. I think it makes Powell less likely to lower rates because he wants to show independence.
Agreed.
Because
Yeah.
we have this national debt, and it comes due, and when it comes due, we refinance. We have to go back into the market, and he doesn't want those bond yields to be high when we go back into the market.
Yeah, it's an interesting thing because I always say be careful what you wish for in terms of cutting interest rates, because if indeed Powell's going to aggressively cut, and not just, they've talked about doing 2 to 4 cuts this year depending on, who you ask within the Fed. That would be an optimistic path in terms of, okay, inflation's coming down, economic growth is still good, we have room to cut interest rates. But this idea, and I don't know that President Trump has stated where he wants interest rates, but this idea, if Powell is going to cut interest rates to, let's say, 1% or 0% tomorrow, and that's going to be a good thing, I very much disagree with that. If we look at the history of the Fed aggressively cutting short-term interest rates, it's only been really during financial crises or recessions. We saw it during COVID, 2008, 2002. These are not good times. So you really don't want to be in a position calling the Fed to cut interest rates aggressively. And as you said, the more you prod Powell to cut interest rates, the more he's going to say, you know what, let's just hold off here. And if we look at the expectations for May, Peter, it's pretty much the market saying this is the meeting 2 weeks from now. Fed is not going to cut interest rates. They're going to wait one more meeting. The expectations June. This is where, if I had to place a bet right now, I'd say the Fed will resume cutting interest rates in June. By then, they'll have more clarity on the tariff situation. If you look at CPI, it's come down this year. It's expected to continue to come down if we look at core inflation. Of course, none of that's incorporating any of the tariff effects, but I think it will be enough in June. And they will telegraph that at the May meeting. Everyone's going to be listening to the commentary. I think they'll telegraph that cut in June, and then from there, it's a wait and see. But the idea that you're going to counteract the damage done by a 100% tariff rate on China by cutting interest rates,
Yeah.
that seems to be what he's applying. I think that's absolutely absurd.
Yeah, very these two things are very disconnected. I think he knows they're disconnected. He wants the lower rates for the debt. He wants to have the tariff war to get some concessions, and you will see how it plays out. To your point, this is something that's not going into summer. We're going to have a lot of answers here very quickly.
Yeah, for sure. In terms of the stock market, I'll say it again, but because it needs to be said, there's no relationship between interest rates, where the 10-year is, and stock market returns. Historically, there's a zero correlation because it's not just the rate that matters, it matters why the rate is at that level. So if interest rates are rising and it's because growth is doing well and earnings are doing well, that's a good thing. But if it's rising because of higher inflation, that's a bad thing. And same thing on the opposite direction. If interest rates are falling, that's because economic growth and earnings are going down. Not very good. If it's because inflation's coming down, economy's still good, that can be positive. So you need to not only know the direction of interest rates, but why they're moving in that direction. And in terms of bond investors, Peter, I've gotten a lot of questions of late. Should people be worried about these fluctuations, these big moves in treasuries? If you're a long-term bond investor, I say no, absolutely not. If you have 7 years, in terms of a bond investor, all that matters really is going to be that starting yield. And if you're between 4 and 5%, like we are today, that should be your expectation in terms of returns. And in the short run, the noise is going to be the direction of interest rates. But in the long run, this is likely what you're going to get. Now, of course, we don't know what inflation is going to be, but this will be your nominal return. There's a 97% correlation between the two. Okay, I want to go to sentiment here. And we got the second lowest reading, Peter, ever in the University of Michigan Consumer Sentiment Index. Kind of studying here, very rarely gets this low. The lowest ever was actually in June 2022 when inflation in the US went above 9%, which is the highest we've seen since 1981. So obviously consumers don't like inflation. And if you dig into this number, why was it so low? It's their expectation that inflation is going to spike over the next year to over 6%. So that was their expectation in the survey. Just a huge run up in terms of what they're expecting, and mostly from the tariff impact. Is this worrying to you looking at consumer sentiment? Obviously, you have to decipher what are they going to actually do with this bad sentiment, but it's kind of remarkable to see it plunge this quickly, this low, without yet high unemployment, without the recession, and all the rest of it.
I love this indicator, but for all the opposite reasons that you would think. I mean, this is a very counter. You should bet the opposite. This is a contrarian signal. You want to see when the consumer throws in the towel. That's when you can expect the rally. That's just basically how it works. And so this study has basically the opposite outcome of I think what people think it has.
Agreed. In terms of stock market performance, no question. Best returns have come after the lowest sentiment readings. You could just see the dates here, right? We had a huge 2023, 2024 following this low reading, obviously during 08, 09, 1980s. Every time it's plunged, stock market has done well following that. But my question would be, do you think this is actually going to lead consumers to pull back, or are they just saying that they're very negative? In your conversations with people, are you hearing anyone saying, I'm going to hold off because of the economic uncertainty in terms of a big purchase, whether it's a car, house, or a trip? Are you hearing any of that just yet?
None of that. I mean, like I think there must be a political element to this survey, like how people feel just in general. It's pretty the divisive world. It's kind of like asking somebody how you feel about a Tesla. Do you know what I mean? Like, yes, people 4 years ago versus today, you get very different outcomes. I am not seeing at all people saying they're going to change with their vacations or what they're going to do. I mean, this does not feel like the last five real crises. COVID, 08, 09, 9/11, tech bubble, all those things this is very, very different. So the sentiment may not be positive, but people's behavior doesn't match what they're saying in the polls here.
We haven't seen it yet in terms of the hard data, and so a lot of people will be watching the actual consumption data for April. We haven't got that yet to see if this is translating into lower sales. It didn't, by the way, back in 2022. It didn't really translate. So people were very negative back then, but they were still buying, and I think that comes down to the employment situation, right, Peter? If you have still unemployment rate hovering around 4% and you have wages still going up, people will still spend until they really feel like they're going to lose their job. We're not there yet. The expectations are that unemployment is going to rise, but I don't think people's behavior is going to be adjusting as much as the sentiment here. But we'll have to wait and see. The longer this draws out, obviously, the more the increased odds that this will actually translate into people pulling back. Okay, in terms of sentiment and valuations, this is an extremely important point for people to understand. The market swings mostly in the short run because of changes in sentiment, and we see that looking at valuations. Looking at valuation is simply a reflection of the sentiment of the moment. And coming into the year, we had one of the highest valuations, and we talked about this a lot, the highest valuations among historically for the S&P 500 that we've seen. So only a few periods were higher. If we're looking at this CAPE ratio, you got to go back to 2000 or 2021 near the peak back then. Other than that, this was the highest valuations in the US that we've seen. And what we've seen so far, Peter, is really just a multiple contraction, not a huge one. And if we look at the Magnificent Seven names, all of them were trading pretty high multiples coming into the year, and all of them are underperforming the S&P 500 this year, and all of the multiples across the board are contracting. And you could say that's because of tariffs, or you could say that's because of something else. But overall, it's just a change in sentiment. There were no fears, no worries a few months ago, and today, now you have people worried about a multitude of things.
I mean, the Magnificent Seven multiple contraction really has nothing to do with tariffs. So if you look at before the tariff thing even started, anyone was even whispering about it. Year to date, at that point, the S&P 500 had been positive, excluding the Magnificent Seven. So the S&P 493 was positive. The Magnificent Seven had been in bear market territory before the tariff issues. So we were seeing at the beginning of the year people saying, "Hey, look, maybe this is a little much. These seven stocks have been on a hell of a run. Most of these are trillion or multi-trillion-dollar companies. How quickly can they really double? Can we justify these multiples, even with the AI revolution largely happening in these companies?" I thought it was, you put these companies together, they were about a third of the S&P 500. I think rightfully so. I think this AI revolution has a lot of legs, and I think it mostly is happening inside these sorts of companies. And so I think you can justify the rich valuations, but it was absolutely priced to perfection. And when something's not perfect, you're going to see contraction. We saw that before the tariffs. I think that part was healthy. What we saw after the tariffs is US stocks across the board get crushed. Small cap stocks go down 15%. The S&P 493 start to get hit too, and international start to do even better. But there was a narrative unfolding even before the tariff discussion.
Absolutely. And your last point here, a million other things are impacting the short run. I just put together a short list here going back to 1989 of different events. And you can see if you go back then, S&P was a dollar in the S&P back then is $37 today. So despite all of these different events here, from flash crashes to recessions to financial crisis, to COVID, housing bubble peak, dot-com bubble peak, all of these different things, Peter, that investors were worried about at the time, rightfully so. These were serious things, many of them. The market found a way to move higher in spite of it.
Yeah, the market finds a way. You just, no matter what situation you're going through, you just have to pause for a moment and ask yourself if 5 years from now, people are going to be, doing things are going to cost more to go to Disney World, McDonald's, and so on. And if you are in a world where you think that's true, things are probably going to work themselves out.
All right. So what about the long run? And this is a chart that you often talk about, showing simply S&P 500 and earnings, and you can see over time the trend is very similar up and to the right. Is this really, if you have 20 years as an investor, 10 years as an investor, and you expect earnings to be higher, is this really all you should be focused on and try to tune out all of these reasons here to sell?
I think this is literally it. The market at the end of the day doesn't care about anything. It doesn't even care about earnings. It only cares about future earnings. That's it. That's the only thing that will ultimately drive things directionally over the long run. It's not going to be perfect, but they're going to match up over the long run. And so to me, everything that's happening every day, do tariffs impact future earnings? They do. Do corporate taxes impact future earnings? Of course. Can interest rates impact them? Sometimes it can. So all of these things are just little pieces of a 1,000 part recipe that just getting us to one thing we care about, which is, do we expect earnings to be higher in the future? If you believe that, if you're a diversified investor and you believe there will be more earnings in the future across the board than today, then you can kind of just relax and not worry too much about the day to day.
Yeah, and another point is important for investors to understand that these difficult periods, they seem like they're going to last forever when you're in the midst of it, and that's understandable. We tend to just think whatever's happening in the moment will continue, but just some historical perspective, you go back to 1949, if we look at the average bull and the average bear, there's really no comparison, Peter. The average bull is a little over 5 years, 254% total return, while the average bear is much shorter, just a little over a year, and 32% decline.
Yeah, it's just when you're living through the bears, something like zero point 0.8 years or 1.4 years sounds like an eternity because it's day after day, minute after minute of the market being open, of just feeling so stupid, sticking with it, right? But when you put it in the perspective of this chart you put up, I mean, it obviously, when you look back on it, you go, oh, well, that's so easy to get through. Different story day to day.
Right. So getting back to your message here, speculators focus on the short run and investors play the long game. So we encourage everyone, play the long game. That's putting the odds in your favor. And at Creative Planning, we can help you with all of this stuff. Reach out to us today, creativeplanning.com/Charlie. Get a free wealth path analysis where we'll look through your portfolio, your financial plan, make sure you're on the right track to financial independence. At Creative Planning, we're in all 50 states and abroad as well, so we likely have a location right near you, over 350 billion in assets under management and advisement. So reach out to us today, creativeplanning.com/Charlie. We're here to help. Okay, let's go to signal or noise. Peter, the dollar index, a lot of people talking about it, and for good reason. I went all the way back to 1973. It took me a little bit of time to do this, but I wanted to see if this was the worst start to a year in history. So dollar index goes back to March 1973. I couldn't find any year on record where it was down this much at this point in the year. So down over 9% this year. The US dollar index is an index that's measured against other currencies. The euro and the yen are the major components in this index, so it's highly represented by those two currencies. But there's other currencies in there as well, and a 9% decline in a short period of time, pretty big. Peter, is this a signal for the markets or noise?
I think it's a lot of noise, but I'm interested in your take.
Okay, so what I'm going to say here is that going back to that March 1973 start date for this dollar index, it started at 100, this index. We're actually pretty much where we were back then. And so just ask yourself, what has the S&P 500 done over this period of time? It's gone up tremendously, which should tell you overall, you don't need the dollar to be weak or you don't need the dollar to be strong for stocks to be much, much higher. And we know that because earnings have gone up tremendously over this period of time. Now, the second question then, Peter, is a big rise in the dollar, which actually we talked about last year, which is pretty funny that we're in the opposite situation today. Is a big rise in the dollar or a big fall in the dollar over a short period of time good or bad for the markets? And what I found historically is neither one has any predictive power. So I went back and looked at the biggest dollar increases, the biggest dollar declines, and this is definitely among the biggest short-term declines. No predictive power in terms of future S&P 500 returns. So overall, almost a zero correlation between stock market returns and the dollar. The caveat I would say, though, Peter, of course, is you don't want an absolute collapse in your currency. So if this were to escalate to an extreme amount, obviously that would not be good. But what we've seen over the past few months doesn't even qualify, although it's the worst year-to-date returns, not the worst, let's say, 2-month or 3-month return. We've seen these types of moves before, and sometimes the market is lower, but most of the time the market is higher.
Yeah, I think that it's very interesting to see because it causes so much turmoil and stress in the short run. At the end of the day, unless you have a collapse, and none of it for the
Do you have a
stock market.
view
For the
long
stock market,
term? Yeah. Do you have a view? I'm interested to hear it. Long term, because there's always a debate. They ask the Fed, they ask president, like, should we pursue a strong dollar policy or a weak dollar policy? Do you have a view on that?
I don't have a view. I don't feel like I feel like when I read about both sides of this and I hear economists talk about both sides of this, I find myself conflicted on what the right policy is. I mean, they each have their pros and cons, and I don't have the conviction around it I do around the other things we've talked about, like interest rates and tariffs and so on. How about you,
Yeah.
Charlie?
If I had to pick one, I would say definitely stronger dollar overall. Just because the risk of what it suggests, right? That a weaker currency we've seen historically when it's just significantly weak, that means either you're having hyperinflation or you're having a period of depression or bad situation. A strong dollar would mean U.S. economy is doing well. There's investments coming into the U.S. and obviously part of the dollar's decline is the reversal of that money coming out of the US. You don't want to see that. So if I had to pick one, definitely would say strong dollar. That also helps, of course, when you have a strong dollar with us importing goods and goods being cheaper. So if I had to pick one, I certainly wouldn't pursue a policy of depreciating the dollar purposefully. I know that Japan has done that for different reasons, but I certainly wouldn't pursue that. So overall, I would say stronger. And last question here, Peter, is in terms of investments, because what a divide we've seen so far this year, because it's kind of stunning. Worst start to a year that we've seen for the S&P 500 since the early 1930s. And then you look at international stocks and they're doing extremely well. You got the international developed stocks up over 8%. This is on pace for the biggest spread we've seen in history with international outperformance. So here's the question: do you want to hedge your currency exposure overseas, or is this an example of why you might not want to do that?
I mean, to me, this is a great example of why you want to be diversified as an international investor because you're getting the currency diversification and it's showing through. Part of the stock price swings in the US and overseas is going to have to do with currencies, and it allows you to diversify some of that risk away.
So just additional diversification, so you don't have to put all of your eggs in the dollar basket. Obviously, you want the dollar to do well, or it's at least not collapse, but not taking a view on currencies and having that as part of your portfolio. Additional level of diversification has hurt, right? The past few years, now it's moving very violently in the opposite direction, as we often see. So diversify, 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 and I would put currencies in that boat as well. All right. Awesome. Thanks everyone for joining us on Signal or Noise today. If you're watching this on YouTube, hit that subscribe button for all the latest content for us, and we'll see you next time on Signal or Noise.